All right, I'd like to welcome everybody. Today is the Princeton Chamber IBA webinar series, and today we're going to be talking about leading and lagging indicators and predicting profit. Yes, very exciting. I'm your host. I'm Lisa McCabe. I'm the owner at First Steps Financial, and I have been a business owner for 15 years, and I have seen a lot. I have worked with hundreds of companies. I've made tons of mistakes myself. So I am, because of those mistakes, I've become a lifelong learner. A little bit about my company. We are a fractional accounting firm. We take care of the financial side for small businesses. We become their fractional accounting department. We step in and we take over everything so the business owner can go and run their companies and rely on us to take care of the financial side. So today we're going to be talking about one of my favorite subjects, and that is leading and lagging indicators. My company runs on a system called EOS, the Entrepreneurial Operating System. And this has always kind of felt like a cheat to me because it's easy to do. And so this comes from that because if you run on EOS, you actually have a scorecard that tells you the health of your company. And there are some numbers you look at weekly and some numbers you look at monthly, quarterly, but there are different indicators that can tell you if you're winning. And that's what this is about. So I am going to share my screen and we are going to get started on this. Again, there are questions. If you have any questions, you can put it in the chat, and I'm more than happy to answer any of them. So, what we're going to be talking about is predicting profit. So, we want to know what's going to happen in the future. As business owners, this is so important, and it helps to make our decision making so much easier. So this is truly focused on, it says bookkeeping information, but really what we're talking about is a lot of numbers that you can get out of your business. So the natural numbers in your business are going to be, hang on, pop back here. Um, Financial indicators. And it's not just about history. It's not like looking back. The reporting that you get, if you have reporting for your company, if you have profit and loss that they give you, the balance sheet, those kinds of things, those things all happened in the past. And that is, did we make money? But predicting forecasts the signals that are going to happen in the future. It navigates using a compass. So it tells you where you're going. So financial statements tell you where you've been, and indicators will tell you where you're going. So leading indicators will tell you um, how to course correct before it's too late. So I'm going to explain what leading and lagging indicators are so that you can get a good idea of what we're talking about, because these things make a huge difference of understanding them. And so the leading indicators are what will happen. So it produce it's metrics that you know that you can look at that are going to predict future outcomes before it happens. So some of these things are sales calls and web traffic and estimates and things like that. And we're going to talk a little more about that. Lagging indicators say what happened. They're metrics that confirmed the outcome after it's occurred. So it's like your revenue. Okay, that is how many sales came in. That is how much profit we made. It's not a future number, it's a number that's happened in the past. So leading indicators give you time to steer, and we're going to focus on that a little bit. And then lagging indicators confirm that you arrived safely. It meant you won the day. So So these lagging indicators confirm the success of past decisions. And this is very apparent on your profit and loss. So you can look at your revenue. It's the result of your sales efforts. And then when you look at your operating expenses, did you use the money that you brought in from the sales effectively last month? So my favorite report ever is called Profit and Loss by Percent of Income. And what it shows you is it shows you from the money you brought in, how did you spend it? How much went to operating expenses, which is insurance, salaries, rent, any of those things? And how much of it did you keep as profit? It's your profit margin. It's an excellent number to look at. It's really good information to have, and it can help you really have a good idea of where things went. And it also does allow you to make changes in the future. So if your operating expenses are too high, you can find ways to reduce them. You can go in and see how much you're spending on different expenses and reduce them. If your revenue isn't high enough, there's things you can do to increase revenue, get more sales. But those are different things that you can do. So your leading indicators predict the health of future financial statements. So this part of it, it might be new to you. It was new to me when I heard it, and I completely nerded out and got super excited about it. So the leading indicators, these are leading indicators, and some of them actually end up being lagging indicators. So let me explain. So your sales activity is a leading indicator. It predicts future revenue. Now, there's different numbers you can do. How many quotes did you put out? If you are in construction, it would be how many estimates did you put out last month? Now, tracking those on in a system, we use QuickBooks Online, but doing your estimates in QuickBooks Online, you can look and see how many estimates you did last month. And you can actually see how many converted to invoices. Invoices can also be a predictor of how much cash is going to be coming in. So there's a couple of things. Again, you have to look at these numbers. So someone else might have, how many people did they reach out to that month? How many calls did they have? And then how many proposals did they send? That will give you an indication. Also, the time frame it takes from the first phone call until you get paid. That's another leading indicator. So things you want to think about, and you have to decide what you want to measure in that grouping. If you have anything in that grouping. The next thing is market activity. How much website traffic are you getting? Are you getting leads from your website? That predicts potential pipeline growth. How many people are you going to talk to? How many people, it increases. Everything's a numbers game. You can absolutely say, if I talk to 100 people this month, I know I'm going to land one client because it's 1%. So then you up that number. All right, if I talk to 1,000 people, it's still 1%. So it's all about numbers, and those are leading indicators, and it's how you can grow your company and predict your future numbers. The other thing is operational efficiency. Now, this is also a leading and lagging indicator. If you look at your employee utilization rate, what you can see is if your employees have too much work on their plate, and you can predict burnout. And it also predicts if you're billing efficiently. So it's a really interesting, it's a good number to look at because you can use it in both ways. Did we use our revenue efficiently? And how are employees doing? Is it too much work for them? You need to have a number in there that is unique to your company. How much revenue should each person be responsible for? How many billing hours? What percentage of their hours should be billed? Those kinds of things you have to look at and decide what that number is for you. And so a dip in quote volume today guarantees a dip in revenue tomorrow. So it is that leading indicator of what is going to happen in the future. So doing this is you're building the bridge between activity and results. So there's external data, there's market trends, seasonability, wars, anything that's going on outside the control of your company. And then there's internal non-financial stuff like your CRM system, project management, time tracking, those things. You want to also pull those in. And then there's the internal financial information, which brings everything together. So there's different things you can do. You can do class tracking in QBO to segment different profitability sectors in your company. So if you sell your services of three different services, so in our company, we break it up into we have basic services, and then we have controller services, and then we have controller plus. So we have three levels of service, and the income goes into those different buckets. And then expenses are by those different buckets. So you can see how much each service is profitable to you. And then budgeting. Oh, budgeting is planning for your future. And so many clients come to us and say, well, I can't tell you what I'm going to make this year. It's volatile. Yes. Take a guess. Give something. If you put nothing down, then you have nothing to measure against. And how do you know if you're winning? And I know it stinks to feel like you're losing, but remember, you have indicators that can help you change how things are done. So use your financial information and remember, everything has a number. So focus on the vital few, not the trivial many. So as a business owner, one of the worst things you can do is try to do too many things at once, but it's kind of the way we're built. We always try to do everything all at once. Um, I'm in a women's business book club, and one of the books we just read said, go slow to go fast. So slow down, take a breath, take a look at what is going to make sense. And it is only 3 to 5 metrics. And it's interesting because with EOS, with traction, one of the things that how they suggest you to find out what numbers you should focus on is if you're on a deserted island and by carrier pigeon they brought you in a report, what numbers could you look at to know your company was okay? You can't talk to anybody, you can't do anything. And so I'll tell you what my numbers are. I have an employee wellness report. So we do a survey to the team. How are you feeling? Good, bad? Are you overwhelmed? Because then that gives me an indicator, even whatever the numbers say, this might tell a different story. It also lets me know if my clients are happy, because if my team's happy, my clients are definitely happy. So that is one number I want to look at. And yes, I want to look at sales. I do. I want to know how much we're doing in sales because I know how much the costs are. So there are numbers you can look at. I also want to know how many leads are in the pipeline because that predicts how much revenue we're going to be bringing in. So there's different things that you can look at, but you have to pick what they are. And they do have suggestions that one should be liquidity, like what's your cash flow forecast, which you should always know. And there's a quick and dirty way to do it. So we have clients that they don't want to see a cash flow. It can be overwhelming to look at it. So in QuickBooks, and this is a cheat, and I'm just telling you, in QuickBooks, in the checkbook register where you do your operational account, you can actually put bills in. So it'll tell you, like, if I pay all these bills, what is my end number going to be? It's a quick and dirty way to do it, but it gets the job done. So knowing how much money you're going to have each week, that is really helpful. And however you get there, it works for you. Um, and then you want a profitability metric. What are you measuring? Are you measuring net income or are you measuring gross profit? Where is that? What makes the most sense to you? And then you want to know about growth and activity metrics. Like how many leads are coming in, how many phone calls are being made, how many Zoom meetings are you having, how many coffees are you having, whatever the predictor is, um, that is, that makes sense for you. So we have a client and he said, I just have to hire more salespeople and I'll make more money. And I thought that was hilarious, but he's not wrong. Because of his training and the way that they train their salespeople, they're guaranteed that each salesperson they hire brings in X amount of dollars. Oh, that's great. So, I mean, there's other levels to it. You have to have people oversee them. But I thought that was really interesting. That is not one of their numbers that they look at, but it goes down to it's really a numbers game. It's really about getting it down to that. So historical trends are going to provide your baseline for that prediction too. So because you know your business, and I have talked to so many business owners, and even if they don't have a QuickBooks file, even if they don't even have it in Excel, they know how much money they're making. They have a good idea of how much is going out, how much is coming in, when they're going to be short, those kinds of things. It's awesome if you have it in QuickBooks and if you have it all available to you because you can see what happens. There are trends. There are trends in every industry. It doesn't matter what industry you're in. Do you know that the stock market is highest in April and November? Look at the stock market this month. It's April. It's super high. It's the highest it's been all year. And it tanked at the beginning of the month, but by the end of the month, it'll be up. November is the same thing. There are always trends that happen. So what you can do is apply those trends to the future. So historically, we are incredibly busy quarter 1. I know that. I've been doing this 15 years. I know personally that's where we are the busiest. Now, mind you, it is tax season and we don't even prepare any taxes, but we support CPAs and our clients through tax season. So CPAs come to us and ask us questions about files and different things, ask us to clean things up, and our clients come with us because they have questions from their CPAs or they have questions about what they need to do. So it's a very busy time. So I know that. So do we have extra staff during that time? Do I know we're going to have a lower profit margin? What are those things and what are those predictors going to be? Because year over year, that's what's going to happen. So there are things to look at for that. Sorry, just moving my screen ahead. So understanding time delays unlocks your accurate forecast. And this was really, this was like so enlightening to me. And it really is about your sales cycle. And the reason why I was led to this was because I do sales for my company. And I realized that for my company to actually grow and to scale, I needed to step out of that position. So I needed to put numbers to everything I was doing. So, how many leads that you need to generate? What's the conversion rate? And how many sales is that going to bring you? And then how many days till you realize that revenue? So, you could predict $10,000 in sales, but if it doesn't come in for 3 months, you need to know that. There are many industries. We have some industries that they get paid on progress invoicing. So they have to meet a milestone when they get paid. And so they may be able to predict that sale. They might have $1 million sale this year, and that's great. But the sales cycle, they might sign on day 1, but they're not going to get paid for 30 days. And then they don't get paid for another 60 days. You really need to know those things, and it will absolutely predict your revenue in months to come. So knowing what this whole formula is like having the keys. It's having that crystal ball. I know there's a lot of woo-woo stuff going on here, but yes, you can predict the future if you have this formula. So It's something that I highly suggest everybody look into and make sure that you know this formula, how many people you need to talk to, what's the conversion and what's the predicted sales, and then how long until that revenue comes in. It will, cash is king. Or do they say revenue is vanity, profit is reality, and cash is king. And that's what you need to know is when that cash is coming in. So if you do this scenario planning, so if you know what your, the cycle is, what are the things that could happen? So in a good year, you could say, like, yeah, we're going to do 40% in sales. It's going to be great. Okay, that would be optimistic. High conversion, short cycle, like, yeah, it's going to be lots of money coming in. And then you have to pick a most likely one, a realistic one. But you also should pick a pessimistic one. And I love, um, we had a cash flow forecast that said if you never make another sale for the rest of the year, this is when you run out of money. And I kind of loved that because it gave worst case scenario. I mean, I don't know when that would happen, but what if it did? So, and it helps you to be able to make decisions as this is happening. So, if revenue B drops below, if the revenue drops below this path B, the most likely of what's going to happen, we immediately have to do X, Y, and Z. We have to cut this. We have to do this. It gives you a plan. I mean, if you were to go on a trip, you make contingency plans like, oh, oh, hey, this traffic. Anybody driven through 95 in Connecticut? There's always traffic. So you have to come up with a contingency plan. What's going to happen? I'm going to take another route. Still going to get there, but I might have to take another route to get there. And that's what we have to be thinking along this. And this information that you're going to get, these numbers are going to tell you when things are not going well and when you're not winning and things you can do. So, um, so you have to recognize three zones of warning. So one is the pipeline. And I think this is probably the most important, and people don't realize it. And it's especially hard in a situation where you are getting referrals for clients because you have no control over that. You don't have control over getting people to give you referrals. You can ask for them, that's great. But that can also be a leading number that you need to really put something on. I have to ask for 3 referrals every month, so I get one. You have to figure out what that number is. So your sales pipeline is drying up, or people are just cycling through and not purchasing. So you really need to figure that out. Um, and if you don't, you are going to have a revenue gap, and it's going to bring down into other things like a cash flow. So the other one is your margins. Now, um, when people see this, typically they're like, oh, the gross margin is declining despite steady revenue. The solution is get more sales. It's not. There's a problem going on internally. There's something going on whether people are spending too many hours doing the work. Something started costing you more. If you work in construction and you deal with copper, you deal with something a lot, and the price of that stuff increased ridiculous amounts, like 60%. Or right now, there's a you know, gas prices have increased dramatically. If you're a trucking company and you have diesel, and someone told me that diesel in California is $10 a gallon, that is a problem. It isn't just more sales. You have to make different changes. You might have to increase your pricing so that your profit margin, so you can stay, you passing it on to the customer, but if there's no other option, that's what you got to do. And cash. So accounts receivables days are increasing, which means you are not going to get paid. And this is something that the smartest business owners that I know are really focused on this. One of my first clients, and she's still a client. When I started working with her, I don't know, almost 15 years ago, she told me, she said, we're going to send out the invoice. She goes, and I want you to call the day before it's due. And I thought, well, it's not due. But let me tell you, I didn't have to make the phone calls anymore because people would pay because they didn't want to hear from me. And I wasn't mean or anything. I was super nice. I said, hey, just a reminder, the bill's due tomorrow, but paid. Never a problem. She never had a cash flow problem from her AR system. And I can't tell you, and I do a whole talk about your AR system because it is everything to your business. It is the lifeline in your business. Getting paid and not chasing clients for money is absolutely the key to having cash in your business. And we have clients that have $1 million on their AR. And it is about making sure they get paid timely. And in some businesses, you can collect payment information up front. You can make it part of your contract with them. If you are doing regular work, lawyers, do a retainer. There's other things you can collect money up front. But if you can't, if you have to get paid, there should be some sort of cadence to when you get paid, when you receive the product, when a milestone is hit, and what the timing is on that, so that you know ahead of time when you're going to get paid so you do not have to deal with a cash crunch. So, one of the things that you can do is make a rapid response. So, if you have an issue of revenue drops, what can you do to change this? Because you know from your numbers, from your leading number, if my revenue is down, it's because something has happened on the lead side. So, tactical fixes. You can launch an immediate short-term promotion. You can go back to old leads. So, we actually track leads that are closed, ones that we didn't end up working with. And we have two categories. We have one that's not a good fit and one that we just didn't end up working with. We go back to the ones we just didn't end up working with that we've really liked, and we will re-engage with them because that way we're still top of mind if they're not happy with their current provider. And I can't tell you how many times they were like, oh my God, I was just thinking about you. We worked with this company and we're not loving it, blah, blah, blah. Hey, we're here. Um, and then review the sales training materials for if you have a salesperson, because even though you think you may have communicated something, and this happened recently in our company, but not in the sales side, we were annoyed with our team for not doing something that we thought was simple. And we're like, oh, everybody's trained on this. We tell them all the time. So finally, someone on the leadership team went back and looked through our training, and it actually isn't written in the training. We say it all the time. So we actually went back and redid the training around it and developed more um, more visuals and more reminders of why we do this and why it's so important. So it can be something that you might think you may have communicated, but it wasn't. Um, all right. Another issue could be the margin squeeze. You could renegotiate supplier costs. And this can happen. We just had tariffs happen, and that was, as you imagine, if you were involved in tariffs, it was very interesting. So we have clients that were involved in this, and we spent time figuring out like how do you accommodate this? And so you can renegotiate supplier costs. You can implement a temporary freeze on non-essential spending. And then you can also increase your prices strategically. This Those are all things you can do. It may not always be just one, it might be a little bit of all three. So you at least have things to do. But the reason why you knew is because you were watching your margins. And the reason why you know any of these things is because you're looking at your numbers and you can react before it's too late, before there's a crisis, before you're getting a loan to pay your bills, and that's not where you want to be. So this is your emergency cash flow kit. If you are having a cash flow problem, if money is not coming in, These are things you can do to help with your AR. The days are increasing and you're like, oh my God, we are going to be out of money. What can we do right now? You can tighten up AR collections immediately. Like I said, squeaky wheel gets the oil. Follow up, follow up, follow up. People are afraid to follow up because they're like, oh, they're going to be upset. No, you did the work. You provided the service. You provided the product. They have it. They need to pay you for it. You are amazing. Don't forget that. You are an incredible business. You are providing something that they need. So, yes, tighten up your AR, follow up with them. You can always offer them a discount. If it makes sense, if they want to early pay, okay, it's not due for 30 days, but if you pay in 20 days, we're going to give you 3% off. People will do that, and it will help you too. So, something that we often suggest for our clients, because we do have clients that have unique situations where they're not going to get paid for 30, 60, 90 days. And that's the way the contract is written. So they know they're going to have to pay their employees to do the work before they actually get paid for the job. Utilize short term lines of credit. But again, only if the pipeline is confirmed, only if you have signed contracts and everything's in place for this to happen. Because there is nothing worse, and I see this happen at times when people get too excited, they start working on something and then it falls off and they're stuck with this line of credit that they have extended and they can't pay it because they never actually got the job. Or the job didn't pan out to be $100,000 job. It turned out to be a $10,000 job and they can't actually pay back their line of credit and they're stuck with that. So that is the worst. Um, so a strategic adjustment can take place looking at your leading and lagging indicators. So the whole idea is to fix the root cause of the problem, and then you will have a sustainable profit. So some of the things you can look at are your product mix. Is if you have these numbers and you can look at them, you can go through and look at which of your services have the highest yield. Where are you making the most money in your company? Focus on that. Automate processes. I am the queen of automation. I want everything done yesterday and I want it done efficiently. And you can talk to anybody on my team. I am like so hot on this right now, and have been for a long time. I want things done efficiently. I want systems to talk together. I don't want errors to be made. I need things to be accurate and efficient. So you can actually lower your cost of goods and your operating expenses permanently by automating processes. There are things that do not need three different systems. We had a client that had three different systems going on to track things. When we were able to put everything together, they only needed two systems. That saved them immense amount of money. And it shortened the time. So it changed their operating expenses because they were paying their in-house people, their admin people, less. They weren't paying them less. That is not the way. They didn't utilize them for those tasks anymore. They could put them on other things. And so it really helped them to reduce that and they became much more efficient. So when thinking like, oh, I need to hire another admin person, they actually didn't. They actually utilized the admin person they had better. So that was a really great way to do that and to automate processes and create that efficiency. And then pricing. Now, this really works for service-based companies, but doing value-based pricing, because value-based pricing is about what value you bring to the customer. And you need to think about that, and that needs to be part of the sales conversation. And I would talk to your current clients and find out what value you provided to them if this is all new to you. But value pricing can really help you know your worth and know that this is what's going to happen. We're going to come in, for example, for our company, we come in as your accounting department. We can save them a minimum of 30% on the accounting side, and that's a minimum. The other things that the value we provide is there's less errors. You have someone on the accounting side that is innovative and is always looking for better ways to do things. And typically you don't have that. I'm sorry, when you have someone in-house that's their only job. Um, so that is our value to our clients, and that they can actually rely on us to do things as they would want it done. So this creates a predictive cycle for you. So you are looking at your data source, you're looking at your numbers, and and you have your forecast created. And then you have actions you're going to take if certain thresholds are met. So if something goes down, like we talked about in the forecasting model, if it goes below that scenario B, you have things you're going to do. You're going to stop uh, uh, non-essential spending. You're going to do, different things. What's going to happen? What if AR goes beyond the date? What are the steps we're going to take? We actually have a playbook in place for AR collections, and it's a 3-step process, and it rocks because it is one of those ones where, you call and you make that very friendly, hey, how you doing? Just want to let you know you're overdue. And, you don't get a response. We got 2 more things after that get paid. We've never had to actually go beyond those 3 steps. So if you can, I'm going to give you homework on this. There's one thing, find one leading indicator that's relevant for your business, and then establish that threshold. So it can be anything. All right, I am going to reach out to, um, you know, three three people that are kind of ideal clients. You could do that. You could ask for 3 referrals from a current clients. You can go out to 3 different clients and ask for 3 referrals. Find something that is going to be a leading number to bring sales in, or a leading number of, I know I need to do X amount of estimates this month because I know 50% turn into invoicing, and I want to make 100,000 this month. So I have to do 200,000 in invoicing. Find your number and figure out how you go about what's the action you can take when you fall below that number, or if that number isn't working, what's the action you're going to take? And that's probably the harder thing, and that requires thought, or asking ChatGPT, because I have to tell you, it's a really good strategic partner. It does actually give some good and interesting information. Like I said, if anybody has any questions, please feel free to put those questions in the chat. I'm more than happy to answer them. I had people send some questions ahead of time. Someone said, realistically, how much time per week should a business owner dedicate to tracking and analyzing these predictive metrics? So, look, we have a business to run. We got stuff to do. But these numbers should be easy enough so that you're taking 15 minutes to review it, make sure you're winning. And when you're not winning, you have an action already set up ahead of time. So it's not going to be a lot of time. It shouldn't be a dread. It shouldn't be something like, oh my God, I have to do this. It should be like, let me see if I'm winning. I'm excited to do this. Tom Brady had a really good quote. He said, football's easy because all I need to know if I'm winning is to look at the scoreboard. So good stuff. Um, so let's see. How often should I review and update my forecasting model to ensure it remains accurate? You can adjust your forecasting model at any time. Things happen. You land a big project. You lost a big client. You can change your forecast, but do it. And even if you do it as your budget, that's still a forecast. That's still guessing what you're going to do for the year. And you can change it at any time. And we do it for our clients all the time. There might be something happen where they get into a group and their pipeline is full. And it's like, oh my God, I thought I was going to do 2 million this year. I'm actually going to do 2.5. can we change things? Because it affects other things. So it really is, you can change it anytime, but at least do it once and then start to measure against it. Um, let's see, what's the most effective and professional strategy for aggressive AR follow-up that can maintain client relationships while improving cash flow? Yeah, it's a delicate line. So, um, like I told you, we have a system. So, and I will share it with you. I'll share your secret system. So, we make the phone call. We send the invoice. We send a reminder. That's a given. Then we make a phone call. Then we send an email that says, um, you know, we need to get paid by X amount of date. If we do not hear, you know, um, these are the payment terms. We need to be paid by Friday. We give them a due date in that email. If they don't pay by that due date, we send another email and we say something along the lines of, in a very gentle way, we want to maintain this relationship. We're very concerned about this. We know how fragile a business's um, financial rating can be, like what your credit score is. And we don't want to impact that in any way, but we are left with very few options. We are now consulting with our collections attorney. Please let us know by tomorrow your plans for paying the bill. And I have to tell you, we've never had to go beyond that because people do not want their credit score hit because it affects so many things, and they will reach out to you and figure out a way to pay. So that is aggressive but nice. Yeah. Smile when you say it. That's all. Well, I want to thank everybody for coming. It's been recorded. You will get a copy of this in your email tomorrow. And it will also go on the Princeton Chamber website. They're creating a little section to have all these videos. And next time, our next webinar is going to be on May 22nd. And if you're registered for this one, you get the registration for all of them. And I'll be talking with Sal Levatino, and he is a business coach. And he and I will be talking about what's the best advice you can get from a business coach, and what books every business owner should read. So it's going to be exciting. So mark your calendars, May 22nd, and I look forward to seeing everybody then. Take care.